Michael Burry, one of the most iconic names in investing. You might know him as the man who predicted the 2008 housing crash, a move that made him millions and left Wall Street stunned. Now he's making headlines again with a huge move in 2024. Burry just sold off more than half of his stock holdings in Q3, according to his latest 13F filing. So, what does this mean for the market? Why would one of the sharpest minds in finance suddenly slash his portfolio by more than 50%? Let's dive into the details. Burry made one of his boldest moves by cutting nearly 90% of his positions in banking stocks. Why is this significant? Banking stocks are often seen as a cornerstone in many portfolios, especially for those betting on economic growth. But Burry's decision to pull out of banks signals he's worried about something major. Banks rely heavily on the health of the overall economy. If there's a recession, or even just a slowdown, banking profits can drop as lending activity slows and loan defaults rise. Burry's move suggests that he believes the financial sector could be in for some rough times ahead. Back in 2008, Burry was one of the few who saw the financial crisis coming, betting against subprime mortgages and making over $1 billion for his investors. Could his recent actions be another early warning? Next, Burry also made significant cuts to his US stock exposure, reducing it by 37%. This reduction includes major players across multiple sectors. But what does this tell us? Essentially, Burry is becoming more cautious about the US market itself. With inflation still high and interest rates on the rise, the risk of a US recession in 2024 has grown. Add in global uncertainties, and it's clear why Burry is pulling back from US stocks. While many investors are optimistic about a rebound, Burry's moves show that he's preparing for potential economic turmoil. Burry's not alone here. Several big hedge funds have also been trimming their positions in US stocks, indicating that the smart money might be anticipating a slowdown or even a market correction. The sectors Burry has been most aggressive in cutting include consumer discretionary, financials, energy, and industrials. What do these sectors have in common? They are all highly sensitive to economic cycles. When consumers cut back on spending, companies in these industries tend to suffer. For instance, consumer discretionary stocks, think retail and luxury goods, are particularly vulnerable when people tighten their wallets. And if inflation continues to eat into purchasing power, this sector could struggle even more. Energy and industrials are also at risk in a slowing economy. If demand for goods drops, industrial companies lose out, and energy demand tends to fall in a recession. By cutting his exposure here, Burry is positioning himself away from the sectors most vulnerable to economic downturns. Despite these massive cuts, Burry maintained some positions in the communications and technology sectors. Why? Well, while these sectors aren't immune to downturns, they have shown more resilience in the past compared to other industries. Tech companies, for example, often have strong balance sheets and global customer bases, allowing them to weather economic storms better than most. Communications services, like telecommunications and internet providers, are often seen as essential even during a recession. Burry's move suggests that he sees long-term value in these areas, even as he reduces risk elsewhere. During previous downturns, some tech stocks have rebounded quickly, making them valuable assets for investors looking beyond short-term volatility. So, what's the takeaway here? Michael Burry's massive portfolio reduction signals that he's taking a highly defensive stance ahead of 2024. With inflationary pressures, rising interest rates, and the risk of recession, Burry seems to believe that the worst may not be over for the market. He's trimming his positions in sectors that are vulnerable to economic cycles, like consumer goods and energy, and reducing his US exposure. At the same time, his strategic focus on tech and communications shows that he's betting on these sectors being able to withstand whatever economic challenges lie ahead. Michael Burry has always been a contrarian investor, often going against the mainstream. Could his latest moves be a signal that we're heading into another period of market turbulence? What do you think of Michael Burry's latest moves? Are you following his strategy or going in a different direction? Let me know in the comments. And don't forget to subscribe to our channel for more insights into market strategies and analysis of the biggest movers in finance. Stay ahead of the curve. Note: this video is based on publicly available information from 13F filings